So the next few chapters of our book, Next Gen Dollars and Cents, focus on many of the financial matters that we all encounter on a regular basis. So chapter 14 discusses what you need to know before you buy a house or before you buy a car. Those are just some of life's big purchases that you need to get right. Buying a home for most people is usually the single largest financial transaction that you'll make during the course of your lifetime. And you'll likely feel the ramifications of the decisions that you make when you're buying a home for years to come. So if you make a mistake, then you're going to have to live with it over an extended time period, which means that the costs are only going to add up. So the entire home buying process comes with many decisions, and certainly taking the time to understand the details involved in buying a home really helps you plan ahead and avoid any of these negative ramifications or regrets. So the first issue that chapter 14 tackles in this conversation is this notion of when to buy a home. And certainly there's a variety of factors that our book, Next Gen Dollars and Cents, gets into in much more detail and encourages you to really consider when you're making this kind of a decision. These include things like what's your overall financial stability, what's going on in the housing market at the time you're in the market, what your personal goals might be. Are you planning on staying in this particular area for a few years? Maybe you're raising a family, or maybe you're just sort of passing through, if you will. The affordability obviously is an important factor of owning a home. There you kind of have to factor in all of those other costs beyond just your mortgage or your taxes or your insurance. Know that owning a home means that you've got maintenance costs as well that you need to deal with. And I guess that's sort of the last factor that the book talks about in chapter 14 is that, are you ready for it? And obviously with owning a home, that means that you've got repairs and maintenance and all of those kinds of things that you might not be as ready for as you think. The reality is that when you buy a home, most likely you're going to need to borrow some money in the form of a mortgage loan to help with that purchase. So a mortgage is typically owed to a bank or other lending institution, and it is secured by that home or real estate that you purchased using the proceeds of that mortgage. So what's in a mortgage payment? Well, chapter 14 of our book, Next Gen Dollars and Cents, details the 5 different components that might be present in your mortgage. So understanding how each of these works is sort of essential to comprehending how your mortgage is going to work and where your money is going to go. So the first component of your mortgage payment is the principal portion, and that principal portion is the amount that directly pays down the amount of that loan that you had to purchase the property in the first place. The second component is the interest, right? That's the finance cost associated with borrowing that money. In the first several years, more of your payment will go to interest rather than to principal, because interest accrues and ultimately becomes a larger part of that payment in those first few years. Next up is the taxes, the real estate taxes. Now, this one doesn't necessarily have anything to do with your mortgage per se, but it ensures that your real estate taxes that you owe each and every year when you own a piece of property is in fact being paid, because it adds it into the monthly mortgage payment, in essence creating sort of a escrow account where the bank or the lending company ultimately holds your money every month and then goes ahead and pays your real estate tax bill on your behalf. The fourth component is another escrow piece, and that is on your homeowners insurance. So again, doesn't really pay or have anything to do with the underlying mortgage itself, but it is a escrow account that typically we see a lot of lenders adding into their mortgages, so that in essence, you're paying your insurance on a monthly basis rather than having that bill all hit at once. The fifth component is private mortgage insurance. Now, this is the one that you want to try and avoid as best you can, because the PMI, as it's known, usually applies to when you're making a home purchase but not able to put as much of a down payment down on that original purchase. The reality is that this insurance isn't designed to help you. It's designed to protect the bank. That's why it's kind of money that doesn't really help you in terms of as you're spending it, doesn't really help you. It really is there to protect the bank. So those are the 5 components of a mortgage. Obviously, the book talks about those in much more detail. We then shift to the conversation of, okay, well, what's the right mortgage? And selecting the right mortgage involves analyzing a number of factors. We talk about 4 unique factors to consider when trying to decide between different mortgages. And first of those, of course, is the interest rate. That's probably the most crucial factor to review when deciding between mortgages. The interest rate obviously determines the total cost you're going to have to pay to borrow the money. So the lower the rate, the lower the loan cost will be over time. The interest rate environment obviously going to be a significant factor in what interest rate you can get on your mortgage. It may also drive whether you should get a fixed or a variable rate mortgage. A fixed mortgage is going to ultimately be the same rate for the entire term of that mortgage, whereby a variable rate mortgage may start out as a lower rate in the first few years and then eventually reset. So if you expect those variable rate mortgages, also known as ARM rates or adjustable rate mortgages. So if you expect interest rates to decline in the future, you might look at an ARM as something to consider in that kind of environment. The next factor to consider when selecting a mortgage is its term. How long are you going to have to pay to get this mortgage fully paid off? So the length of a mortgage directly determines the amount of your monthly payment, and ultimately a longer term generates a lower monthly payment, but because the payback period is longer, then you're going to pay a higher total amount of interest versus a shorter term mortgage where the payments are due over a shorter term. To fully pay that mortgage off within a shorter time period, you're going to have higher payments, but because of that shorter payback period, then you may find that your interest rate is going to be a little bit lower as well. So that's the term analysis when it comes to your mortgage. Next up to consider is the loan to value. That is a ratio that is calculated looking at the amount of your loan and comparing that to your property value. Now, the reason loan to value amount is important is that's where that PMI, that private mortgage insurance that we talked about earlier in this video, comes into play. If you don't have 20% equity in that purchase of that property, then you typically wind up having to pay PMI. So that's where that kind of comes into play. And then lastly, of course, make sure you consider the closing costs that you will pay. Those are the costs associated with obtaining a mortgage. Typically include about 2% of the borrowed amount, include fees for preparing the loan paperwork and securing the bank's interest in the property as its collateral. In that case, make sure you shop around and make sure that you are paying the least amount of closing costs that you can. The book also contains a discussion about home equity lines, which is a type of loan allowing homeowners to borrow against the appreciation in their home. A HELOC, as it's known, it operates as sort of a revolving line of credit where you can draw from that line of credit as you need, which thereby gives you some flexibility to be able to use the funds for various purposes like home improvements or debt consolidation or the like. So on to the second single largest financial transaction that people make in their lives. And this one they'll probably make a number of times during the course of their life. And that is purchasing a car. So like buying a house, the first step in purchasing a a car is to review your budget to calculate what you can afford. And don't forget to add in all of those extra ongoing costs like insurance and fuel and maintenance and so forth. So the biggest financial issue with cars, in our opinion, is that far too often many people treat them as status symbols. They view owning a particular car as a reflection of who they are and want others to see them in the latest and greatest and coolest vehicle. Another concern that we have from a financial point of view is this practice that some people have of really trading in a new car for another new one every few years. And unlike real estate or other assets which generally appreciate or the value goes up over time, cars don't do that. Cars depreciate, which is the other way where the value is going down. And they do so relatively quickly. On average, a new car will depreciate about 20% in the first year and then 15% each year for the next 3 years. So that new car will only be worth about 35% on average of its original purchase price within a 4-year period of time. In terms of car buying, there's 3 distinct payment methods for acquiring a car. Each sort of has its own advantages and disadvantages. If you're using cash to purchase a car, right, that's a great way to avoid having the extra expense coming into your budget on a monthly basis, but it does reduce your available savings. Financing allows you to sort of spread out the expense over time, but adds in the interest rate costs. In today's world, car financing rates are quite a bit higher than what you would normally expect to see. So you need to be very careful about what that interest rate is that you're paying on that car loan. And then lastly, leasing. And leasing sometimes affords a lower monthly payment than financing, but it is in essence just renting the car. So we would urge you to be careful about that option when you're looking at purchasing a car. Chapter 14 of our book, Next Gen Dollars and Cents, concludes with a general discussion about insurance. Obviously, insurance and the total cost of insurance that you pay for your health insurance, your homeowners insurance, your auto insurance, that combined line item in your budget typically represents the 3rd most significant financial expense that people incur regularly. So the book has a discussion on what insurance is. An insurance policy, of course, is a legal document that defines the rights and obligations of both the policyholder and the insurance company. It outlines the policy-specific terms and coverage details. And certainly the terms of any particular health insurance policy or car policy or homeowner policy can certainly vary dramatically. So make sure that you understand the terms of your particular policy. When, of course, an insured event occurs, such as an accident or a death or a theft or whatever the case may be, the policy holder can file a claim with the insurance company. The amount paid by the insurance company is then subject to the limits and conditions that are specified in the policy itself. In the book, we also discuss the importance of an umbrella policy, which is a specific type of policy, insurance policy, that provides additional liability protection beyond the limits of your normal car or homeowners insurance policies. And we conclude with sort of a discussion about 2 different types of life insurance, which are whole and term. The choice between whole and term life insurance depends on, obviously, individual circumstances, financial goals. Term life insurance is often suitable for those seeking temporary coverage for a specific time period at a reasonable price, versus whole life is more for permanent insurance with the potential of accumulating some cash value in there. There's much more of a discussion about insurance in the book as well. But that's sort of a summary of our discussion about 3 of life's big purchases that we encounter on a regular basis in all of our lives. Obviously, more fully described in Chapter 14 of our book, Next Gen Dollars and Cents. You can get your free copy of our book by texting free copy to 407-791-0070. That's 407-791-0070. 7070. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, and author of Next Gen Dollars and Cents. Thanks for watching this video.